Steve Leisman has a special guest. Hey, Steve.
Yeah, very special guest. We are joined, Carl, by Austan Goolsbee, the Chicago Fed president, who doesn't shy away from joining us on days of big reports. We had him last, I believe, when the jobs report came out. So, yeah, thanks for your courage here, Austan. Let's get down to this data here. CPI, I don't know, a little bit on the higher side, on the hotter side. Mildly so anyway. Your reaction to that combined with the pop-up in claims that we saw this morning?
Yeah, look, Steve, every time we talk, I always say, let's not get worked up out of one report. These are noisy series. Inflation came in around what people were expected. There was improvement on the housing front on inflation that was masked a little bit by deterioration on the goods front. But the overall trend is what's important, not the day-to-day fluctuations. And the overall trend over 12, 18 months is clearly that inflation has come down a lot and the job market has cooled to a level which is around where we think full employment is. And we'd like to get both of them to stay kind of in the space where they are right now. And that's what I'm thinking about. That's what everybody's thinking about when we're trying to set policy.
Also, when you talk about setting policy and kind of looking through the data, are you still in a process here, or will you be over the next, say, several meetings in a process here of trying to use the word that the chair has used, recalibrate policy to take account for the prior decline in inflation?
In a way, it depends what the definition. As you know, the rules of the FOMC, I only speak for myself, and I'm speaking for anybody, and certainly not for the chair. I found myself in total agreement with the spirit of what the chair said in the press conference, which is, as I view what's happened, we've gone through a long period where we had almost exclusive attention to the inflation side of the mandate because we had to. Inflation was way higher than the target, and the job market was white hot and extremely strong. And we've shifted now to a more normal environment, a balanced risk environment, where we got to think about both sides of the mandate, maximizing employment and stabilizing the prices. And when the hardest thing, as I always say, the hardest thing that the central bank has to do is to try to get the timing right when there's these moments of transition. And so, to me, it's been a series of close call type meetings, and there'll probably be more close call type meetings. But we get to meet every 6 weeks precisely because we want to get it right and not get too far ahead or too far behind.
So close call can have a double meaning depending upon what you're talking about. 25 or 50, it was a closer call. We learned from the minutes yesterday than we thought between 25 or 50. Now the market is thinking about, well, the two sides of that coin are to hike by a quarter or to pause. Is it possible, Austan, that the Fed would skip a meeting, at least among the next couple ones?
You know, I'm never going to tie our hands on what we're going to do when we still got a lot of data coming in and we're trying to figure out what's going on. And I want to hear from what my colleagues have to say there at the FOMC. But nothing's ever not on the table. We're always thinking about the conditions that we've seen and what's coming in. We're consulting with business leaders and civic and community leaders around. We're looking at the beige book type information, trying to figure out what the circumstance is. So I don't think anybody should be stressed out.
I get that.
We consider all possibilities.